Hi guys, so we're going to continue on today with the 6 ratios that we need to know for A2 business studies. So we looked at 4 yesterday or previous lesson, and we're going to continue on with the 2 more today. Okay, so what I'm going to do first off is grab 4 fingers just to get us warmed up, and for each finger put one of the ratios on that finger. Okay, what is the formula of each one? What is the usefulness of the formula? And by that I mean, what does it tell a business? So what is the relevance of that data? Okay, so just pause the video for a minute or two and just think in your head without looking back at your notes. So the first ratio we spoke about is, I would calculate it in this way, and it tells a business. Okay, so just spend a couple of minutes thinking about that. Okay, so today, as I said already, we're going to be looking at the 6 key performance measures. So remember, the purpose of all of this is to look back at the previous trading period, the previous financial year, and calculate 6 key performance measures. So we can measure and then compare to other businesses, we can compare to previous years, we can put it on a time series graph and say, are we performing better, are we performing worse, what might be the reasons for that? That's going to help us to set objectives, and from our objectives we set strategies, which we know plenty about. Okay? So, the final 2 ratios that you need to know about are measures of liquidity, and I believe we did these in year 12. If you've got GCSE, you will definitely have done these, but let's go through them in detail, make sure that we all are comfortable with these liquidity measures. Okay, so what do we mean by liquidity? I said the word several times already today. Just have a little think to yourself for a second. What is your understanding of the word liquidity? Okay, so liquidity is the ability of a firm to pay its short-term debts. Okay, so business always needs to make sure that it has enough liquidity, it has enough liquid assets, and we're going to talk about what liquid assets are shortly, in order to pay its short-term debts. And that's debts that need to be paid within a year. Okay, so that could be creditors, money that you owe, other businesses you owe money to, because you've bought items on trade credit, maybe an overdraft, maybe a short-term loan, or any other short-term debts that the business may have accrued. So basically what we're looking at is working capital, so the cash used to pay for day-to-day bills, is that larger than our short-term liabilities, or are our short-term liabilities greater than working capital? So if your working capital is greater then your short-term liability is great. You're liquid. You've got enough liquid assets in order to cover your debts in the short term. However, if your short-term debts are greater than your working capital, then you have a liquidity problem, and ultimately, if you have a long-term liquidity problem, that is going to lead to the end of the business. Okay, running out of cash flow, running out of liquidity is a major problem of businesses. Over trading is growing too quickly and running out of liquidity. Okay, common reason businesses may fail. So let's have a look at the actual formula set. So the first one we need to know about is the current ratio. Okay, so we call that the current ratio. So we take all our current assets and we divide that by current liabilities. We don't times this by 100. We leave this as a decimal, and that will tell us how liquid are we. We've then got a second measure called the acid test ratio. So this time it's very similar. We take our current assets, but this time we take off stocks. Okay, why might we take off stocks? Have a think. Well, the thing with stocks is that they could get damaged, they could go out of date if it's something that's perishable, they could get stolen, they could get burnt down in a fire, they might depreciate in value if they become out of date. There's just no guarantee that we actually might sell those stocks, or we sell those stocks for a reasonable price. We might need to discount them in order to get rid of, in order to shift those stocks. So what we're saying there is, even if we can't sell our current stock level, have we still got enough liquid assets in order to cover our short-term debts, our current liabilities? Okay? So our current assets Could be cash. Obviously, that's the most liquid of all assets. It's cash. You can use it straight away. We've got stocks, as we've already discussed. Hopefully, you will sell that stock within a year, so therefore it's a current asset. And debtors. So that's money that's owed to you. So that could be from customers, or that could be from retailers. So if you've sold your product to a retailer on trade credit, they might owe you money, so that is debtors. Our current liabilities could include overdrafts, so money that you would owe the bank, creditors, so that's money that you owe to other businesses, usually for raw materials or finished stock, and any kind of short-term loans or any money that you owe out within 1 year. Okay, so what I'd like you to do is you now have everything to work out the current ratio and acid test ratio based on these numbers. Okay, so you should have got the current ratio at 1.39, and you should have got the acid test ratio at 0.96. Okay, so what does that mean? Well, basically, anything over 1 means that you're liquid, because if it's over 1, that means that your assets are greater than your liabilities, so you don't have a liquidity problem. If it's less than 1, that indicates that your current liabilities are greater than your current assets, and you do have a liquidity problem. Okay, so this business basically passes the current ratio, 1.39, but they fail the acid test ratio. So if they don't sell that stock, or that stock gets damaged, or that stock needs to be discounted heavily, or that stock just disappears and we can't sell it for some reason, maybe it gets damaged, maybe the warehouse gets flooded or something happens, then we don't actually have enough liquid assets left to cover our current liabilities. Okay? And that's basically liquidity ratios. So what I'd like you to do now is we have got, on the left-hand side, we've got an extract of a balance sheet, and on the right-hand side, we've got an extract of an income statement. So based on this information, you should be able to work out all 6 ratios that we've discussed this week. Okay, so just to go through the income statement really quickly. So we've got SR, sales revenue, costs of goods sold, gross profit, overheads, and profit for the year. Okay, so pause the video, have a look at all this, and you should be able to calculate 6 ratios. See how many you can do without looking back at your notes, without looking up the formulas, because you need to make sure that these are in your memory so you can use them in an exam. As I said last lesson, this is really commonly examined on the 20 markers. Okay, so pause the video. Can you calculate 6 ratios without any assistance? Okay, so let's have a look through some answers then so you can check off your answers. So I got the gross profit margin at 40.5%. So that would be gross profit divided by sales revenue times 100. I got the profit for the year margin at 22.3%. So that would be profit for the year divided by sales revenue times 100. I got an ROCE of 2.9%. So I took my, how did I work that out? Total assets, I think, of 508, and then so I took profit for the year, 14.7, divided that by 508 times 100. That gives us 2.9. Just double check that's correct. I don't want to misinform you. So we got 14.7 divided by 508 times 100. Yep, 2.9. Okay, so yeah, I took that 14.7 divided by 508 times 100, and that gives us our ROC, so the return on the capital employed, so the total assets is the capital that's been put into the business, and then we've made 14.7 million from those assets. The gearing ratio tells us how much debt, how much of that capital was paid for with borrowed money. So I would take my long-term loans of 125, divide that by 508, and that should give me 24.6. Let's double check that again. So 125 divided by 508, yep, so 24.6. So that indicates that 24.6% of all of the assets the business owns were paid for with borrowed money. Okay, so reasonable amount of gearing there, but not perhaps too risky a business. 75% of everything they own was paid for with their own money. That's a reasonable position to be in. So moving on, the current ratio is 0.9. So they have in effect failed that current ratio. They have a liquidity problem at the moment. And then their asset test ratio is 0.44, which is quite a significant liquidity problem. So if, as we said, if for some reason they don't sell those stocks, they're going to have a major liquidity problem in the future. Okay? So you should now have a reasonable understanding of all six performance measures. So what I would like you to do to finish off, and then this is probably going to take you some time in your hour and a half that you should be spending on Unit 3 anyway, is to produce a revision sheet like this. So you can use a piece of paper, or you can use something like MindMap, or I believe this is Coggle. So we've got profitability margins, of which we would have 3 in there. We'd have ROCE, we would have net profit margin, gross profit margin. We've got the 2 liquidity that we've just discussed today, return on capital. Oh no, so you can put ROC down there actually, that shouldn't be in profitability margins. The gearing ratio, and then what I want to start to do is thinking about the usefulness of these ratios and the limitations of these ratios. Okay, we will go through this more formally next lesson, but I need to start to think, why is measuring your performance using ratios like these a very useful thing for a business to do? And then what are some of the limitations of this type of measurement? Okay, so that's it for today. We will have a live lesson early next week to talk about these ratios, make sure you understand them. You can ask any specific questions. So we will have a Google Meet first lesson next week, which will be Tuesday. So Tuesday next week, we'll have a live lesson so we can actually interact back and forth. If you've got any problems, obviously email me or drop a comment on this video. Okay, hopefully that's not been too long today. Any problems, like I say, let me know, and we will have a Google Meet on Tuesday to go through these ratios. Okay, have a nice weekend, and I shall speak to you, hopefully face-to-face on Tuesday. Okay?